Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm joined by John Blank, Zacks Chief Equity Strategist, to talk about what's going on out there. As you know, if you are a subscriber to this podcast, I have John on every couple of months to talk about whether or not a recession is coming, what's going on in the economy, and some stocks you might want to be taking a look at. But this time, a lot is going on in the economy. The Trump administration is in office. The tariffs are back. And it seems like almost every day we're getting a new tariff announcement of some sort. And there definitely is a trade war going on, but it's not with who we thought it would be. There is one with China, but nobody cares about that right now. It seems to be that Canada is in the crosshairs, even more so than Mexico for now. And so a lot is going on with announcements about Canada and Mexico and tariffs right now. Additionally, we're starting to hear from some companies now that maybe the consumer's getting a little bit nervous. Maybe they're starting to pull back a little bit, and that could mean we may see some slowing in the economy, but I'm going to ask John all about that. And then we have the market selling off on all of this news. So where should you be putting your money, if anywhere? Maybe we should all be Warren Buffett sitting in our cash hoards on the sidelines. But as many of you know, trying to time any stock market is nearly impossible, even for Warren Buffett. And he's talked about that many times over the years, especially in the 2008, 2009 sell-off during the Great Recession. He said, you cannot really time it, but he was always making a bet on America and its companies. So, John, welcome back to the show.
Thanks, Tracey.
So, John, we're back, in 2025 with a much different type of situation and setup than when we last talked in December of 2024. That's always how it works, it seems, with the markets and the economy. But let's start off with what is going on with the recession question, because that's kind of looming out there. And over all these years, we've talked on this podcast many times about what it takes to be in a recession and what we should be looking for. And obviously, the first thing we always look at is employment. But we're not really seeing, a significant pullback on the employment side. We haven't seen any negative BLS reports yet. And we're not even really seeing the BLS fall under 100,000, which many people would consider to be a negative because you might not be replacing those who have lost jobs once it goes on under 100. But we do know that employment is a lagging indicator. So what should we be looking for right now if we think like this is it? We're finally going to get this recession that everybody's been waiting for at least 2 years.
Well, Tracey, we've had a long wait for a pullback, and we're only down 5.5% on the S&P 500. The last 3 months are down 8%. So a lot of what's happening right now is just getting a valuation reset on the S&P 500 valuation, led by tech stocks and consumer discretionary stocks, which is in many ways completely sensible to the situation we're in, which is consumer discretionary is automobiles, it is appliances, it is trips, and when you attack tariffing that goes straight to the automobile cost, it goes straight to the appliance costs, and of course we've had the airplane crashes and a lot of poor weather in this time of year. So it all makes sense what's happening so far. And it's only 2 sectors of the 10, and it's only 8% in the last 3 months. So at this point in time, given what you already spoke to, which is the fundamentals at non-farm payroll level, 151 last month, and pretty much 165 over the last 12 months, which is, meaning that last month was not minus 10,000 federal employees, was basically in line with the long-term trend, is that the momentum from the last 4 or 5 years of the U.S. economy is very strong. And right now, the best call to be made is we're in a correction of the stock market that's long overdue.
Okay. So people are kind of panicking about a recession too early.
Too early. Yeah, I mean, I looked at the professional forecaster survey from the Philly Fed this morning, and second quarter, it just came out like 3-4 weeks ago, Tracy, 15% chance of a recession in the second quarter and 20% chance in the third quarter. We're in March the 11th today. We're only 3-4 weeks away from the start of the second quarter, and we certainly don't have one now. So markets do look beyond the third quarter to recession probabilities. And, at this point in time, that's where, markets can sell off and facing that one. But, I always warn you in this environment that not to prognosticate on the economy until it shows up in the coincident indicators. So the idea that there might be a recession in 6 months is not enough for us to call it right now.
So what do you think the Fed's reaction is going to be to all this? We heard from Chairman Powell just last week at one of the conferences he spoke to, and he's going to be talking at a couple more conferences coming up, as he does every spring. But he did manage to soothe the market. He acted kind of nonchalant, like, we're not really seeing that much change in the underlying data. The jobs market is weakened a bit, but it's holding up. And inflation has come down and continues to come down, which is great, and what they want to see happen. So do you think that it'll be more of this kind of Fed soothing over the next couple of months?
Yeah, I mean, what I noticed, again, when I looked into it, the Fed projections will come out here next week on the 17th, 18th of March, when they'll give us the new summary of economic projections. So that's the real hard evidence of the Fed changing their mind at this point in time across the regions in a meeting. So before then, I can only rely on the December projections, which is 4 cuts for this year. Were already in place back in December. The CME Fed Funds futures got really spooked about the hot print on the consumer inflation number and drove it all the way up to now 1 or 2 cuts this year. And what's all that's happened, Tracy, on that front in the last day or two is now we're back to 3 cuts this year, which is still not where the Fed was anyways. So again, a lot of this is, the market dancing around between two parts of the dual mandate. One is, we still have hot inflation. We still get a number coming out tomorrow on inflation. It still matters. It's still too high. Tariffing is not going to help that matter. It's like a 0.3 boost, at some point if it plays out in a dramatic way, which it may not. But at the end of the day, they have a dual mandate and they have not met the high inflation mandate. So, the other reason Fed Chair Powell is cautious is it's not just the recession and unemployment he's worried about. He's worried about both high inflation and a possible pullback in unemployment.
So stagflation?
That's the word throwing out. I don't think that's appropriate because that's a supply shock, 1970s era term. What we're facing here is a populist government shock. And I think that's really relevant. I mean, if you look at trade policy uncertainty on the Federal Reserve System, Fed website, it has popped up trade policy uncertainty, which is driven by, tariffs, trade war in the news to COVID levels. So what's happening here is populist stuff where you throw words into the media, trade war, tariffing, emergency. And this creates for people out listening to news a great deal of engagement with the president. But this is not a story where you've gone to the Congress and you're passing tariff legislation, over a lot of products and goods over a long period of time. It's just not what's happening here. So the drama of the populist news to get the base excited has to be met by actual tariff news that's more substantive than we've seen. Even today, Tracy, we know he doubled steel and aluminum tariffs on Canada. That's just de minimis stuff, very large soundbite stuff for the stock market. Again, the main worry is that it's something down the road that he keeps hammering away at, not this particular news either.
Yeah. We know that the stock market is kind of forward looking. So, can we read anything into this new pullback that it is kind of anticipating something occurring, a little bit further down the road, not right now, maybe towards the end of the year kind of thing?
Yeah, that's absolutely it. I mean, the more he goes at this, he nicks away at things until he draws blood, and then he draws blood until we have an injury. And this is a populist shock. And typically, what happens here, or what's happened in this time, is disintermediating the legal system and the normal process of constitutional democracy by issuing emergency orders for everything. Emergency order on this, emergency order on cutting, emergency orders on efficiency, whatever you want to do, you create an emergency and you push it around the normal system of affairs. So this is also getting tied up in the court system, because obviously we're not in an emergency, Tracey, and we're using emergency legislation. So again, what's happening here is we're getting a lot of news and excitement around everything, but then the litigation, and you're an attorney, you know this, is going to start taking over and go through the appellate process to the Supreme Court. And we're just going to see a long, drawn-out litigation on these trade sanctions and everything else. Because every single person out there who's negatively affected on the trade tariffing is going to say, hey, this 1977 law on national emergencies is not being applied appropriately, particularly in Canada, where the fentanyl numbers are simply too small to create enough of a real issue inside a courtroom, let's put it that way.
So, what's an investor to do right now? A lot of people kind of got complacent, I feel, because I know I did, on that, this rally is just going along, and we would have a little bit of a pullback occasionally, but we haven't had a big one since really 2022. And so even though that was just 3 years ago, it feels like forever ago. And so now I'm looking at, what areas do we want to be in here? Do we want to get really defensive, or should we be, quote unquote, buying the dip on the Mag 7s or some of these tech names that have really pulled back? What is your suggestions for people who are, a little bit freaked out right now and kind of frozen and unsure what to do?
Yeah, Tracey, we have the VIX option volatility indicator out there, and it got up to 29.5. And if you look back over history, the time to put money to work is when it gets over 35. So we're getting close. But the real answer to a trade signal and putting cash to work is to wait for that 35. And by the way, now we went up to 30 here, we might drift down, to 18 or 20 before we just spike up to 35 again. So we're in a zone here where, even on the VIX, we didn't get a 35, we got a 30 in the last few days. So what you want to do is be very patient with your cash here. There really is not a good evidence that you can make a lot of money. The large cap trader, I got 18 picks in there today, Tracey. I had a 0.3 a tick green on Meta and a 0.3 of a tick green on Amazon, and they're both red now in the afternoon. So yes, there is some evidence for the pre-2000 Mag 7. I mean, pre-2000 meaning not Tesla, not NVIDIA. Those companies, I think, when we do get that big VIX pullback, will be buyable. Tesla is foreign money that showed up, post 2000, and it kind of exemplifies something that's being radically protested around the world. And I'm a bearish on Tesla because it's not macroeconomic related; it's political related, it's populist related, like I've already spoken to. NVIDIA is the other one, and in NVIDIA's case, this is the science parks of Taiwan that have, made their great impact on the United States in Silicon Valley. It was a great story, but, I honestly think, a lot of the upfront investment in those data centers has been made, and there's also a lot of capacity constraints at the Blackwell chip level for NVIDIA to supply. So you might have to look elsewhere, the AMDs and even the Intels of the world, or even smaller chips, to find a play here, because I think that one is also overdone, but for very different reasons than Tesla. So my version of the tech world is we're starting to have it mature into a 25-year-old story, and you've got to look at those early names, and that's where I look for a bargain pick.
Okay. I've often said about any company that when they make the front page of like the Wall Street Journal or the New York Times, but it's not for a good reason, then I don't like to be in it. So I've sold out of companies that have made the front page, for some kind of scandal or, DOG investigation or DOJ investigation, something like that. And I've just been like, I don't like those kinds of headlines. I can't figure that out as an investor. So I'm out on those types. And Tesla right here kind of reminds me a little bit of that. So I'm still on the sidelines. I've never owned Tesla. And there's just a lot of headlines right now that are not, as you mentioned, necessarily business related, although there have been some of those recently too. Okay, what about the banks? Nobody's really paying attention. Everyone still hates them, but the big banks like JP Morgan was hitting new highs last year, new all-time highs. And those were very hot stocks last year. They were seeing quite a big pullback here, maybe because they were just, way too much last year on the rally. But what is your take on some of these bigger banks here? Should I have them on my watch list like a JP Morgan? Or is it too early to consider, diving into any of those?
I think it's too early, Tracy. I mean, and the names that I'm seeing are the smaller regional southeast type banks where you get a mortgage rate pullback and there's some buying of possible mortgage activity in those groups and construction loan activity. But yeah, I think that run was out of the Fed rate cutting. And, also we've got, a little caution flag because the March 17 projections on what the Fed's going to actually set for rate cutting now. So certainly not before then. And then when we got to see, also just how much they just get market baited down in the sell-off because they definitely were the leaders on the way up. So one has to assume there's going to be at least a one beta correction on the way down for those guys.
Okay. I wanted to just take a look real quick at the JP Morgan chart just to show people kind of what was going on there. I like this price and consensus and surprise chart that's on our site now. So you can see the sell-off right there. But I mean, look at this. Over the last 2 years, it's nothing compared to what's been going on with the stock. And great earnings surprise track record. And you can see for now, the earnings are expected to be up this year and next year, but forward P of 12. You can't really totally look at the PEs for the banks, but that's not super cheap on a PE basis. And then down here on our sales and EPS growth rate chart, you can see earnings actually for this year expected to be down 8.2% and then rebound again after last year's stellar numbers there, 21% up. So, yeah, I'm keeping an eye out on a lot of these banks, but as you mentioned, especially the more regional, smaller banks or even some of the community banks, they've gotten really beat up in the sell-off. I feel like any of the small caps, I know you're the large cap editor of that portfolio, but I do watch a lot of the small caps and they are just getting demolished right here. So there might be some real buys there. I'm probably going to do a podcast on the Value Investor podcast about the banks because of this big pullback. So stay tuned for that if you're interested in the banks. But what about another area that's really hated? We never really talk about it because it's been hated for so long. And that's really energy and really the big oil, Exxon, Chevrons of the world. And those were big and earnings went up during the start of the Ukraine war when energy prices soared. Energy prices came down hard and starting in 2023 and then even last year, 2024. And now WTI back under 70 here with the word out that the Trump administration really wants to get it to 50. And now we have OPEC Plus starting up more capacity while all of this stuff is kind of going on globally. But these stocks have really sold off in the last number of years. And now maybe you could even say this could be an area you might want to hang out in because they have sold off so much. I'm taking a look at just ExxonMobil here, which is not actually one of the ones that has sold off, but you can see it's been in this trading range since oil started going down after the Ukraine war started. Here in 2023, 2024, it's on the lower end right here, but it hasn't broken down. I've kind of been waiting for Exxon to break down because you can see the earnings are on the decline here with the fall in oil prices. But what is your take on some of these big oil companies, or even the just pure plays, oil producers like a Diamondback? I'm putting up that chart, but you can see it's broken down a little bit more than Exxon has, but it's still kind of trying to hold on to these gains. What about this area right now?
Well, Tracey, this is another classic populist maneuver where we're getting drill, baby, drill, and we're getting all kinds of climate reductions, and we're going to improve LNG shipping and all these things for the soundbite. And as you can show on these charts, that the market is trading it on a range trade because it's not impressed and it's not convinced there will be any follow through. And that is actually, again, that's the populist mystery here. And then we're, the rest of the world, we've had elections in Germany, we've had elections in Canada, we will have an election in Australia, and a lot of the rest of the world's figured out how this populist thing works and are not voting for the populists. So my personal feeling is, there is no energy trade. It's a range trade. And until otherwise, those estimate revisions are the expert opinions, and you can look right there on Diamondback right at the screen, and the expert opinion is it's not going anywhere.
Right. That's why I've kind of been staying out of them as well, because this is not the kind of chart I want to see with it, down and to the right under where the stock is trading. And these aren't that cheap now that earnings are declining, even because they haven't pulled back far enough. And so, yeah, I've also been kind of on the sidelines, but I'm keeping them on my watch list. One other area, and then we'll wrap up, that we haven't talked about is the big pharma, the weight loss drug stocks, and other big pharmas. People seem to be hanging out and hiding out in some of them here in 2025. I own AbbVie in the value investor portfolio and my own personal portfolio, ticker ABBV. And I talked about it on a podcast last week when I talked about stocks breaking out, because it has been hitting new all-time highs while all this other craziness is going on. But what is your feeling on some of these big cap pharmas? They were out of favor until weight loss drugs came about, and now they're back in favor. But, is it too much for these stocks? Will they eventually capitulate too if we get a bigger market sell-off, or is this somewhere where I could hang out?
Well, go ahead and hit LLY, Tracey, and ticker LLY. Let's take a look.
This is the big Eli Lilly, one of the big weight loss drug stocks.
So what we're looking at is that it's been range trading since last summer for the last 7-8 months.
Yeah.
So there's no play. There's no play in Lilly. It's fully valued. And we'll go ahead and ticker NVO, Tracey, see what they do. That's the other weight loss one.
Novo Nordisk.
All right, Novo Nordisk is where there does. Now, they've had some issues with Wegovy. Not getting as strong as sales. You can see those estimate revisions coming down. So
yeah.
But I would be more tempted with NVO than I would be LLY, because I think they're a European name, and I think the old indices that stock is put in are broad indices of European shares, and I think there's going to be a bid on those shares.
Okay. You can also see earnings expected to be up 17% this year and 21% in 2026. Of course, that's a little bit below what it has been doing since the weight loss drugs exploded a couple of years ago, but that's to be expected. But forward P now on Novo Nordisk is just 20.5. And it says on Zacks.com, we have a PEG ratio of 0.85, which does mean it has both value and growth. So, this one could be a more interesting play. As you said, you do get a little bit of a dividend, 0.9% on Novo Nordisk. So it's definitely cheaper than Eli Lilly here, and it has pulled back. So, okay.
Yeah, no, this is a great name. This is what you're looking for. 140 to 680. You got a nice, really big Fibonacci pullback, and it's done a two or three tests of the 80 level on the downside. And yeah, this is a name with a low beta 0.4 environment with a 0.85 peg. Tough not to like a stock like this.
Yeah, agreed. I'm putting it on my list for the value investor now. We kind of missed the weight loss trade. We were in Eli Lilly at the beginning of the pandemic, but we did sell out just before, it was 6 months before the weight loss thing exploded. And then it was just all of these stocks were simply too expensive for us to get back in. So we've been on the sidelines, but yeah, I'm going to take a look at it. Any others that you feel like someone maybe should keep on a watch list here that we haven't talked about?
Yeah, the one name it's really interesting that I picked up on, GPC.
GPC.
This is Napa.
Genuine Parts.
Now, Napa, let's see what the chart shows you. Yeah, so Napa's done nothing but move sideways for 3-4 years, but now with the tariffing on the Canadians, how many cars get used parts and fixed up and stuff like this? I'm kind of intrigued by this stock. I've owned it. It hasn't done a damn thing for large cap traded for a long time, but it's one of my stocks that gets held up during these sell-offs really well because
Okay.
I know what the story is. This is one of those closet positive tariff trades. There's very few of them, but this is one.
Yeah. Those estimates are coming down pretty hard from last year, but stock is pretty cheap. It says here forward P of 16.
Right. You got a decent story out of 2026, which is getting closer and closer in.
Right. Yeah, I see that over here. Earnings expected to rise 13% in 2026 after declining just 4.4 here in 25.
This is an under radar pick. I've just noticed from the share trading environment the last few days that I figured out what was going on here. This is like, this will work when tariffs go up. Stock.
Right. Yes, you can see that it has an upward slope on the chart there for the shares.
Yeah, just the last few days. You can see what I mean?
Yeah.
Yeah, and then, it's definitely, you start thinking about it, and then you realize what's happening, right? There's a good bet out there, a pretty prescient one that if it's going to be $8,000-$10,000 more for a new car, then why don't I just fix the one I have?
Right, for sure.
Yeah.
And you get a dividend yielding about 3.2%, which is pretty nice little dividend.
This is this has been a total dog stock, as you can see, for a long time. But when people give up on a stock after 4.5 years, you might want to look into it. You know what I'm saying? From a value perspective.
Yeah. Okay. Okay. Well, I guess we've covered most of the things I wanted to cover for today's episode. And always, I will have John back on, maybe even sooner rather than later. We'll see what happens out there with everything going on in the economy, with tariffs, with the stock market. But for now, some good advice and some good stock picks that I'm going to repeat again, the ones we talked about. So we did talk about AbbVie. ABBV is a ticker. I own it. I own it in the value investor. Exxon is XOM. Diamondback Energy, which we showed, the chart for that is FANG, FANG. That's a pure play producer, not big oil. We talked about some of the banks, JP Morgan Chase, JPM. We talked about NVIDIA, NVDA, Tesla, TSLA, Novo Nordisk, N as in Nancy, V as in Victor O, Eli Lilly, LLY, and Genuine Parts, G as in George, P as in Paul, C as in Charles. And Genuine Parts is the one that John feels like maybe something is going on there. So you might want to check that out. And just on a side note, I do own Eli Lilly in my own personal portfolio, but not any longer in the Value Investor. So as always, you want to be sure to subscribe to get the Zacks Market Edge, because there's a lot going on out there, and we'll be bringing you stocks, ETFs all year long. So be sure to get us on YouTube. We're on Zacks.com/YouTube or Zacks Investment Research in the toolbar. Just subscribe to get it every week. I know many of you are watching over there, and I thank you. Be sure to like it as well, because that helps us get in front of more eyes over on YouTube. And you can get us on Apple Podcasts and Spotify. Anywhere you can get us on podcasts, you will get us. But be sure to get us somewhere, and I'll see you again next week with some more stocks.